and welcome to today's sessions. We're going to go ahead and get started since we're 1 minute over, and we're talking about one of my favorite subjects today, which is the options Greeks. So very excited to dive in. I'll go ahead and have the chat and the Q&A open in case there are any questions along the way, but definitely a great topic to cover, and we'll go much deeper into that. Nonetheless, if you've never attended a options play education session where options play a third party that's working with First Trade in order to build you or build education experiences and make sure that you understand those foundational aspects that is options trading, and the options play education arm, our mission is just to empower you to trade sustainably and confidently. Always like to share that before we begin. If you don't know me, I'm Jessica and Skip, the Director of Education and Product here at Options Play, and my job is to make sure that we bridge education and application, bring those complex topics to life. And now, naturally, before we dive in, I do want to share some important information. Know that options do involve risk. They're not suitable for all investors. There are certain requirements that have to be met, normally a separate application and approval that's required. There is a document, you've probably seen it before. It's called the Characteristics and Risks of Standardized Options, distributed by the OCC, that goes through really a lot of educational aspects of options, how they work, because they're complex and there's nuances that are involved. And know that everything here is essentially for informational and educational purposes only. This material is by a third party, which is us, Options Play. We are not affiliated with First Trade or any of its affiliates. Therefore, any opinions and views that are expressed are not of First Trade. Pause to read. And then, of course, our Options Play only disclosure here is, again, informational, educational purposes only. Sometimes we talk about securities. It's not intended to be a solicitation or offer to buy or sell securities, not individual tax, legal, or investment planning advice. All right, so let's go ahead and dive in. Whenever I talk about the Greeks, I like to start with this T-chart. And this is certainly a more advanced session where we're going to talk about the components of the Greeks, how they work, but more importantly, how an options price is affected. So we'll cover that very briefly, but I want to keep this as engaging as possible. If you've never seen this before, this is a T-chart. I was first introduced to this, honestly, when I took my Series 7 over a decade ago, which is crazy to say. But nonetheless, if you've never seen it, let me describe it to you. We'll have calls on the left-hand side and puts on the right-hand side. Essentially, we put bullish strategies on the top here and bearish strategies on the bottom. Long calls are the first upper left side of the quadrant, and then we put short calls below, and then everything inverse corresponding. And the purpose of this is if you just understand long calls. So if you are ever confused with options trading whatsoever, you go back to long calls, you make sure you understand that inside and out, and then you can utilize this chart as essentially a mirror to figure everything else out. And we're going to build this chart. If you've attended any of our previous sessions where we talk about options pricing and understanding long calls and long puts and the individual strategies, we actually start by building out this chart. So this is really the second step to that. So I want to make sure we review it because we're going to build this out throughout this entire presentation. So long calls, you'll notice some similarities. Long options, they are purchased for a premium. They contain the execution rights. So whenever you hear the word long, I want you in your head to think purchased. Whenever you hear the word call, it is the right to buy. The word put, the right to sell. The is very important in there because then we want to add on short. So if we say the word short, I just want you to think sold, and then put would be the right to sell, call the right to buy. So whenever we are purchasing options, we are purchasing the execution rights. We have the right to buy or sell the underlying, depending if it's issued as a call or a put. If we have a short option, we're obligated to take the other side and fulfill the terms of that contract, which means if we have long options, we are very largely directional. We're purchasing options. We are profiting from a sharp movement in our directional bias. And you can see that with the goals that are associated here, which means we want the stock to overcome the premium that we paid. And the Options Greeks are completely focused on all of these metrics. We want the stock to move more than the premium that we paid for long options, which means time decay, because remember, we purchased time. That is a component of an options premium. That's moving against us because it makes the option diminish in value as it gets closer to expiration, which means it's a negative factor. Very important to know, but that means it's a positive factor for those short options because we sell those for an upfront premium that we collect in exchange for that obligation to fulfill the other side of that contract. But that means we have a slight directional bias, but we're actually neutral with that slight directional bias. So it's important to know the goals that are associated with each of these individual strategies. We're going to utilize this to boil down and break down the Greeks. But you'll notice that if you just focus on long calls, if anything seems like it's not making sense, feel free to take a screenshot of this and focus on long calls and everything else will make more sense. All right, so moving on. So why would we study the Greeks? First of all is options pricing. I just gave you the quickest view of an options price, and we'll break it down a little more. But the purpose of the Greeks is it tells us the changes of that options premium. The options are a derivative, which means it's derived from an underlying security. And some of the Greeks are a derivative of a derivative, but we'll break it down, no worries. But that means that the option is not only derived from the underlying security, there's other factors that affect it, like time and implied volatility. And so if we want to know what happens if the underlying security moves, what happens as time decays, what happens as implied volatility adjusts, what even happens with interest rates, the Greeks tell us that. When we understand how something is priced, and more importantly, how that priced moves based on various events, that's how we can figure out our strike selection, our expiration date selection, optimal entry and exit points. The Greeks can help us figure that out. And that helps with position management. Some fun things that happen that equate to risk, where it's best practices that we talk about all the time, but it's backed up by what the Greeks do. And I'm happy to share that with you today. So real quick, let's do an overview of how an option is priced. Again, you might have seen this slide before. If not, it is the most foundational element to understand the options Greeks. If you do not understand this, then it's impossible, or very difficult rather, to move on. So just a quick example, we'll breeze through it. We have the underlying security ABC. Let's say it's trading at $103 per share. We've got an option that is a $100 strike. It's got 30 days until expiration. DTE means days until expiration. And the premium or last price of that option is $5. So the premium is made up of intrinsic value and extrinsic value. Intrinsic value really means internal factors that affect the option's price. That would be if the option has executable value, which we refer to as in the money. This option is in the money because it's a long call, which means we've purchased the right to buy at $100 per share. Since ABC is at $103 per share, the difference of those two is $3, and therefore it's in the money by $3. Important to note, an option is not always in the money. Extrinsic value is really external factors that affect the option's price, which is time value and implied volatility. Again, interest rates and dividends are a component as well. That's the excess amount of the premium. So the premium is $5. The excess amount, the difference between 5 and 3, is 2. That's extrinsic value, which moves based on external factors and is normally depleting. But we need to understand the positive and negative factors of our options premium. That's what the Greeks are, and that's the way that I framed this to make sure that we apply it. All right, so what affects an options premium? Just going to look at this through the terms of through the lens of a long call and a long put. And remember, a long call means I've purchased the right to buy. Long put, I've purchased the right to sell. So if the stock moves above the strike price, well, if I've purchased the right to buy, that's going to be a positive factor. That's going to make the long call more valuable. May not be profitable just yet, but it's going to make it more valuable as it goes up. The inverse is going to happen with the long put. It's going to become less valuable because it contains the right to sell. And if the market is pricing in a better price, then that contract becomes less valuable. Conversely, if the stock moves down below the strike price, since we have the right to buy with the long call, that's not going to be valuable because now the market's more favorable. Long put is going to be more valuable because we have a higher price point to sell than the market. If there is less time until expiration, remember these are long options, so purchased options, both will be less valuable because time is depleting, and that, as much as I would like to, cannot go back in time. So therefore, it's a decaying factor. And if there's an anticipated movement, for example, earnings, actually makes the long call and the long put more valuable. Think about earnings. It's a specified, and the example is earnings. These are economic events, even news that's expected. Nonetheless, there is I love to use earnings as an example because there is a specified date. We know that there's an analyst consensus, and generally the stock moves up or down in either direction quite a bit. And it depends on if they hit or miss analyst expectations. Then, of course, the future expectations from forward guidance, and then there's conference call speak. There's a lot that is anticipated movement that is just accumulating that could potentially make the stock more valuable. So therefore, the option is more expensive because it's more likely to be in the money. Therefore, it is more expensive. We'll break these down even further, but notice how I've categorized these between external and internal factors. So let's start with delta. Delta, by definition, is how much does my option move if the underlying moves $1? That's the question it answers. Definitions are great, but I prefer a practical application, so we'll break that down. So delta is a theoretical estimate of how much the option's value may change given a dollar move up or down in the underlying security. So you might see it in an options chain like this. We've got XYZ as our example. If that stock moves up $1, if we have a call with a 0.3 delta, then that means if XYZ moves up $1, the new premium, or the premium, is going to move up by 30 cents. And also, if it's 0.6 delta, then that means the new premium will move up by 60 cents, all else equal. So how is it measured? So it ranges from -1 to +1. This is important, really important to understand because of the way that we apply it. 0 is an option where it's neutral strategies. You see how we have it on the scale from red to green. When you're on either end of the range, as in really close to -1 or +1, that's when the option starts acting like the stock. So if I'm buying a call, this is my destination. As the underlying moves up, the delta is going to move closer to 1. If I have a long put and the underlying moves in my favor, should say move down, I apologize, I'm going to have a delta closer to -1. So therefore, I am going to, this is my destination for long options. Short options, just the inverse. We want them to go to 0 because that means it doesn't have any value. And it kind of makes sense, and we'll go through that on an option chain, but I want you to frame your mind as in the destination, or an option really, at expiration is either has a delta of 0 or 1. It has value or it doesn't, because everything else is going to be removed. At expiration, time value is completely depleted, and normally it's worth only its executable value, which means it's going to, if it has executable value, it'll have a delta very close to 1. If it doesn't, it's going to have a delta very close to 0. That's in the case of a long call. That's its destination. It's profitable if it's at 1. Just hold that nugget and we will dive further. So if the stock moves up for a long call, it makes it more valuable. So the delta will move closer to 1. Long put, less valuable, delta moves closer to 1 too, closer to 0. So greater deltas, they're beneficial for long options, as in you want them to magnify, because as it moves closer to positive 1, that means bullish strategies are doing well. So let's break that down with some examples. This is an older screenshot of Shopify, but I like having older screenshots because you can go back and reassess as well. Nonetheless, Shopify is purely for informational and educational purposes only. On here, I have a screenshot of an options chain, and you'll notice a 19.5. Shopify is at 31.73 when this was taken down 6% for the day. This is a very deep in the money option. This strike price is 32. That's our very close to at the money option. And we've got a little slightly out of the money option, which is a 37 strike. So the right to buy at 19.5 is way more favorable than the market of 31.73. 32 is about equal, slightly less favorable. 37, very much so less favorable. And what you'll notice is this is all 30 days until expiration. The 19.5 option has the highest delta. It's already very, very close to its destination, which is 1. Its mid price is $12.43, and it only has 20 cents of extrinsic value. The vast majority of that option is only intrinsic value, and that's because it's at its destination. The at the money option has about a 0.5 delta. Its intrinsic value is 0 because it's not in the money. So it only is made up of extrinsic value, those decaying factors. And then the very far out of the money option has the smallest delta. And of course, it's also only made up of extrinsic value. So you can see how this is closer to its destination. We are pretty much at its destination, how the deltas increase. And you can also see that right here is delta on the options chain as it goes up, as the option moves deeper in the money. So let's bring this back. How would we utilize delta? Well, delta is used to assess directional risk. You can net options together, and if they are a positive delta netted together, it's going to be a bullish strategy. If it's a negative delta netted together, it's a bearish strategy. That's why a lot of times when we see, I think there's 42 different types of option strategies that are out there, at least within our platform. There are many others, but regardless of the name, this will show you your directional risk. And you can even do this for your overall portfolio. Even if you learned about market makers or hear that term, how they have delta neutral portfolios, that means they don't profit from the stock moving up or down. It's just neutral, and that's its directional risk. So this will tell us our directional bias, really. So covered call is a great example. If we're long 100 shares of stock, that's a delta of 1. If we sell a short call, it's going to be a negative delta. That reduces our net deltas, which absolutely makes sense. I don't even have the strike here. And I know that this is an out of the money option. But when I sell a covered call, or I sell a call against my long stock that I own, I'm receiving a premium. That's the give, but the take is capped upwards potential. This is lowered directional exposure because I've lowered my net deltas. That's one way to utilize it. The second is even an at the money straddle. This is a very common strategy used to even price earnings moves. But for those who say, oh, I want to profit from a sharp directional move in either direction, you could actually have a directional bias depending on your deltas. So if you really want a true net delta, you would look at the deltas rather than the strike prices. This is a equivalent 100 put and call. And this has a positive bias, as in a bullish bias, ever so slightly. So it also tells us stock sensitivity. If you have a greater delta, then you are going to have greater exposure to the stock, which makes perfect sense. If you are going to, if you have a delta of 0.9 and the option moves by $1, the stock moves by $1, the option is going to move up by 90 cents. If you have a delta of 0.5, it's only going to move by 50 cents. So you have more exposure of that dollar to dollar if you have a bigger delta. And I've said it a couple times, but I'll say it once more. +1 or -1 means it's acting like the stock now. Those are those very deep in the money options. And it starts losing its time value regardless of time left until expiration, and also its liquidity. It's also used for assessing the probability of in the money at expiration. Higher delta has a higher probability of expiring in the money at expiration. We utilize that a lot, especially when we are choosing our covered calls or when we choose strategies. We talk about deltas often, and it's from the probability perspective. It makes sense. A higher delta has a higher probability of expiring in the money because it already is in the money if it has a higher delta normally. The long options benefit from greater because you want it to move closer to 1, and short from shrinking deltas because you want it to get closer to 0, which is why when we talk about covered calls, we talk about those smaller deltas because we want to make sure that we have a probability of it expiring out of the money. So that's when it realizes its maximum profit potential. So let's put everything together, and this is the chart that we're going to build on today. We need to decide what are the positive and negative factors for long call short puts and short calls and long puts. So for delta, long options have, or excuse me, the bullish strategies have positive deltas because the delta tells us, regardless of what you call it, your directional bias. So these are bullish, they're going to be positive. Short options, so the short calls and the long puts, have the bearish strategies have a negative delta because they profit when the underlying moves down. That's the simple positive and negative factors. We talk about options strategy drivers all the time. You can do the same thing with the deltas. All right, theta. And we spend most of the time, I will say, on delta, and then we cover theta, gamma, and vega as well. So know that delta is really the foundational crux for the rest. So theta tells us how much that option is going to decay each day with all factors remaining the same. So if one day passes, the XYZ call with a 0.3 delta means that the premium is going to move down by 30 cents. So what is my time decay, essentially? Theta is not only time decay, though. It is extrinsic value decay. Very important to note. Apologize about that little view there. But theta is represented by dollar values. So it can be a very, very, very big number. I remember when Amazon used to be in the thousands per share, theta would even be in the 40s or even the 50s. It can be really, really high because it's daily theta decay. So there is no limit on really what you would see on the options chain. Theta decay is going to benefit the seller because it's a decaying option, or decays the options premium. We sold it for a premium, which means we want to buy it back at a lower price on an individual basis. So that's going to favor the seller. It's going to hurt the buyer. It's something that we have to overcome when we're buying, something we want to make sure is an optimal environment when we're selling. So back to those events. If there's less time until expiration, the long call and the long put will become less valuable. Theta is going to increase for both of these because that time decay is going to magnify. And it accelerates, especially for those at the money options. So meaning theta is not linear. It moves off of a cliff. It's kind of like how when you get older, time just seems to go by quicker and quicker. It's like theta decay. It's a straight line, and then about 14 to 21 days until expiration, theta decay just rapidly decreases because time has run out. That extrinsic value accelerated. When your option expires, it's normally only worth its executable value or nothing because time's gone. Makes sense. That has a negative impact on long options. And also something to note when we were going through that T chart, if it is a negative factor for long calls, then just flip it for the back to those math equations. If we were going to sell this, then it would make it a positive number because two negatives make a positive. All right, looking at theta now. So that's this line here. We have the same options, the deep in the money, the at the money option, and the out of the money option. The very deep in the money option, it's at its destination. It doesn't have a lot of extrinsic value. Therefore, it doesn't have a lot of theta to decay. It's got 20 cents that it needs to decay by the time it gets to expiration, all else equal. And remember, these are 30 days until expiration. So this is going to accelerate as we get closer to expiration. This is all extrinsic value. It's got a theta of 0.04, and then the out of the money actually has less theta. So hopefully you've noticed that theta is actually centered around at the money options. It's doesn't move in that linear fashion like delta does. It is the highest around those options that are closer to the underlying, which is important to consider. And we need to throw in other factors to help us understand. But what I want you to take away is what are the positive and negative factors for those individual options legs. And here's a screenshot of an option at expiration. So go 30 days. And what you'll notice is so it's 31.76, 31.5. These are the at the money options. Here is your theta here. It is very much still centered around those at the money options, as are the other Greeks. Options are only worth their executable value or not. You can also see the delta is you're either at 1 or nothing. And it also changes throughout the day. So how do we actually use it? We use it to assess our extrinsic value exposure, which we want that for short options. It's working for us. We want to sell premium when things are inflated. And it's something we have to overcome that when we purchase those options. So long options, regardless if it's a call or put, will have a negative theta because they're purchased options. Short options will have a positive theta, regardless if it's a call or put, because it's a sold option. And then combined, you can do the same thing. You can reveal your net extrinsic value exposure. Great examples of bull call spread. Here we've got a long 100, 110 call spread. So this strategy will profit as the underlying security moves up to 110. The intent of the bull call spread is to reduce the cost of the long call in exchange for capping your gain potential, the give and the take. When you do that, while you're reducing your cost, you're reducing your theta exposure because you're selling theta against your long theta. So therefore, you minimize those decay efforts. That is just a great example of the Greeks in action based on principles we already know. Another is a bull put spread. So we'll flip this around. This is another bullish strategy. This is where thetas are in our favor. And notice how the strategy driver, or the one closest to the money, in this case, this strategy benefits as long as the underlying security is above 110 and remains above 110. And that decay in value, because this is a sold strategy, will benefit us because we want to buy it back at a lower price. So positive and negative factors. I hope you are getting this one right as we put them on the screen. Theta is going to be negative for your long options, regardless if it's a call or a put, because time decay is negative. You notice how these goals are now attributing to the Greeks. And it's positive for short options, regardless if it's a call or put, because time decay is positive. Those options decaying in value is a positive effect on those options. So that's what I mean by the positive and negative factors. Literally, the Greeks are positive or negative, depending on how it affects the option. Let's go into gamma. I will say this is my favorite Greek, so I will try not to monologue on you. But gamma tells us, how much does delta change when the underlying changes? Delta, it's a derivative of a derivative, if you will. That's what gamma is. So gamma is going to tell us what delta's new value will be. So delta is going to change if the underlying security moves up or down by $1. It changes constantly, but it tells us by $1. Gamma will tell us our new delta value. So if the stock moves up by $1 and an XYZ call has a 0.2 gamma, that means that it's going to make delta increase by 0.2. XYZ call with a 0.08 gamma means it's going to move delta by 0.08. So since this is a measurement of, or it's derived from delta, it's on the same range from -1 to +1. Bring back that destination. If we're buying calls, our destination is +1. If we're buying puts, our destination is -1. That's our destination. Gamma is like your engine that's going to get you to that destination. We'll bring that back. Long options are positive gamma because they are directional. So we want a higher engine to get us to that destination, because a higher gamma is going to get us closer to that delta we're looking for. Short options have negative gamma, and that's because they recognize their maximum profit potential when delta is at 0. The option doesn't have any value. So therefore, gamma is beneficial for buyers, and it equates to risk for sellers, because higher gamma means higher directional risk, because delta is directional exposure. So if we have a higher gamma, we're going to have a higher delta, which means we're going to have a higher directional exposure. Great if we're buying, risky if we're selling. And we'll break that down more. So in the event that a stock moves up, makes the long call more valuable, it will have a positive impact on delta, because that's getting us to our destination. The long put is going to be less valuable, so it's going to have a negative impact, meaning the payoff profile is positively convex for those long options because it's moving in your desired direction. All right, back to the option chain. Now, this is, if you've ever heard of gamma theta trade-off, this will come into play. Before we dive into that though, gamma is found here on this column. We've got our deep in the money, at the money, and out of the money option. So looking through this once more. Gamma is the highest you've noticed, or hopefully noticed. It's centered around at the money options. That's where the highest acceleration is. And it makes sense. If we had if I had more of this options chain here and we saw the further out of the money options, it'd have a lower gamma because you're in the sense of a bicycle in order to get to your destination, which is those deeper, you want it to move up in value. So you can literally think about that and how the option changes in value when you look at an option chain with all of the Greeks. As that option moves, though, to its destination, gamma is also removed. That's why it's centered around at the money options, because it's already where it needs to be. Gamma has done its job. Gamma's job is to get delta to 0 or 1, as in your option is worth executable value or it's not. Once it's done its job, it is removed from the equation. And here we go. Here's that at expiration options chain. Gamma is here, and you should see how high gamma is. It's still centered around at the money options, but it is the highest at expiration. So it's meaning it's centered around at the money options, but as you move closer to expiration, gamma also increases. And that's the theta gamma trade-off, meaning you're losing some time value, but you're gaining that momentum, which equates to risk. Think about that. When we're buying options, we want to make sure that we sell back or sell to close time value that we purchased, and that helps us determine our optimal entry and exit points. When we're selling options, we want to buy it back at a lower price, but we're exposing ourselves to directional exposure, meaning since it is neutral to slightly biased and we hold an option till expiration, if we're selling, it could quickly move in either direction and make us unprofitable. And that's lots that happens here. Since gamma is centered around at the money options, lots of things will happen. Even when your bull call spread is at maximum profit potential, gamma will flip to negative because now you've created this synthetic short position where you just need it to stay where it is. Otherwise, you'll start losing profit. So there's so much that you can do with this, which is completely unnecessary to understand, but I find it very interesting. So how do we use it? Same thing here. Long options, they have a positive gamma. Short options have a negative gamma. You can still combine everything together to understand what your directional momentum is. So this bull call spread, and it can have a positive or negative gamma because remember, it's centered around at the money options. We want to have some gamma exposure when we have something like this because this is a directional trade. So the long call individually is going to be that positive gamma. We reduce our gammas because we're capping our gain potential with a bull call spread. But once the option starts or the underlying security moves in our favor, because this realizes maximum profit potential, once the security gets to 110, this will flip gamma negative because the 110 would be closer to the money. And then this would be a higher gamma, which means directional as it moves, we could lose profit. That's essentially what that means. It's risk. So putting that all together, adding gamma to the T chart here, positive for long options because they profit from a sharp directional movement. That's why we have the word sharp here. And we use sharp whenever we first introduce options, so you would understand the Greeks. And you have a negative gamma for short options because they profit from neutral to a slight directional movement. Any greater gammas equates to risk for short options. Greater gammas help us for long options. All right. And last, but certainly not least, let's talk about Vega. So Vega answers the question, how much does volatility affect my option? Vega, it measures the amount of increase or decrease on an options premium based on a 1% point change in implied volatility. Implied volatility, the definition is just the market's anticipated movement of the underlying security, likely anticipated movement of the underlying security. So Vega should not be confused with implied volatility. Implied volatility is high around earnings. That's why I give that example early on. So if implied volatility were to increase, options with a 0.17 Vega, that just means how the premium will move. So you notice how all of these Greeks show you how the premium is affected. If implied volatility goes up, that means that the option is going to increase in value by this much, 0.17 Vega, 17 cents, 0.10 Vega, 10 cents. It's in a dollar amount, so just like theta, can be any number. And long options have a positive value because an increase in the options premium benefits the long options. Decrease in the options premium would benefit short options. And since an increase in implied volatility makes it more expensive, it favors the buyer and not the seller. The increase aspect is how the positive and negative factors are determined. So again, back to this options chain once more. Vega is also centered around at the money options because Theta is a component of extrinsic value, which is also inclusive of implied volatility. Vega shows you the changes in implied volatility and how it affects your options premium. You can see that here and how it's the greatest. Vega is actually higher and more sensitive to changes in implied volatility the longer dated the option is. That's important to note. So how do we actually use Vega? Use it to assess our volatility exposure. And it also puts together some perspectives as well. All long options, regardless if it's a call or a put, will have a positive Vega. Short options, regardless if it's a call or put, has a negative Vega. Combined, you can see the theme here. Will show you if you have volatility exposure or not. Meaning, do I expect there to be an increase in implied volatility, perhaps in the overall market, maybe in the underlying security? A lot of changes and shifting happening within the market today. If that's the case, I want to structure my trade accordingly. And this is how it helps with strike selection. And oftentimes we'll say, whenever you sell a covered call, we want to do this when implied volatility is already high and we expect it to come down. That's why it has a negative Vega, because if there was a decrease in implied volatility, that would benefit that overall strategy. Whereas this bull call spread is a net long strategy, meaning, it is a purchase strategy. It benefits, makes its maximum gain potential when XYZ is at 110. Therefore, an increase in implied volatility will make this leg go up, makes this one also more expensive, which could be bad. So, but since it's net long and this was the driving, I would want a positive net Vega in this case. But there's also a trade-off. But this is the structure and why I think it's so important to understand the Greeks. It gives you a lot of the foundation of not only how options are priced, but how everything around options change and helps you choose what strategy you want to pick. Now, options plays tools are literally built with these mechanics where you don't even have to know what any of these mean in order to trade options. But I find it very, very helpful when choosing strategies to say, oh, okay, well, I see a high implied volatility rank. Therefore, I want to have a negative Vega options, which is just sold options. So perhaps I'm going to look at covered calls at this point or a credit spread. That's how I would utilize these to understand strategy selection. Because oftentimes we say, okay, if I'm looking at a strategy, I know that I am bullish on this stock. There's so many different option strategies you can do if you're bullish. So how do I choose that? Well, if you understand if you understand the Greeks, then you can layer that onto your process. Do I expect a sharp directional movement? So on and so forth. And that's why the quadrant's very helpful. Is now you can utilize what these are intended for and utilize the data points that you see, even simply on an options chain or options plays tools that simplify this for you. So Vega, positive for long options, regardless if it's a call or put, and negative for short options, regardless if it's a call or put. And you can see literally how less the delta, because it gives us directional exposure. Everything is literally a mirror. And this is just such a helpful chart to decipher absolutely everything. But back to that previous statement, understanding these helps you decide which one of these I would like to trade. This is definitely a more advanced session, but if you've attended any sessions where we talk about even four-legged option strategies, beginner option strategies, you'll notice that there are a lot of option strategies, and you may be bullish and even on an individual basis and say, do I want to purchase a call or sell a put because I'm bullish? Which one do I do? And we talk about risk versus reward, but as far as what you think the stock's going to do, because remember, an option is derived from stock, we have to look at the other factors too. So I know I'm bullish. That gets me on, I need a positive delta. We know how time decay will affect these options. So that helps us choose our expiration date. Am I largely expecting a sharp upwards movement or neutral? That's my gamma. So if I am expecting a sharp upward movement, I want to make sure that I have good gamma exposure. And do I expect an increase in implied volatility? Do I expect that to happen? If so, then we want to make sure that we have a positive Vega. So you can see how that helps you narrow down which one you would choose. And additionally, you can layer these together. You can reduce your directional exposure. This would be your bull call spread example we were using the whole time. If we were to reduce for a bull call spread, because remember, they're strategy drivers, we would reduce our directional exposure, but the trade-off is we also reduce our theta exposure. So there's a positive there, but we are reducing our positive factors. You can see what's reduced when you are creating and structuring these strategies. Taking it back to basic math class, where just positive and negatives, what happens when you add those together? All right. Well, that is all. I know First Trade has added some Greeks within their options chain, so I encourage you to check that out and just even watch the Greeks to understand how they work and affect your options price. I think they're certainly very fascinating. Perhaps that's why I like options. But yeah, if you have any questions, we've got a couple moments. Please feel free to put them in the Q&A. And I will go on mute for a few moments while you do that. All right, see a few questions there. Where were the screenshots of that option chain taken? That is a platform that no longer exists, which is fine. There were updates to it. So unfortunately, Justin, I don't have an answer for you. Runtorio asks, what are the best stocks to buy into? That is not the intent of today's presentation, but I appreciate that question. That is certainly investing is personal. You know, when you are talking about individual securities, even though I certainly do quite often, I can give you some best practices associated with it. The reason why it's personal is everyone has different risk tolerances. You may be on your accumulation wealth stage, in which case you are able to take more risk than someone else who has already accumulated their wealth and are looking to protect it and need that to retire. So that's where it really varies depending on where you are within your investment journey and the risk that you're willing to take. However, whenever we're trading options, we do have a couple of rules, but the primary is not spending more than 2% of your overall portfolio within one trade. And especially when we're buying options, we look for a 3-to-1 risk reward ratio, meaning you want to make sure you can make 3 times more than what you're spending. And that is, you can do the math on that. Essentially, that means if you're only using 2% of your portfolio and you have that 3-to-1 risk reward ratio, if you are wrong, when you are right, it overcomes way more when you are wrong. So I will leave you with that tidbit of information. All right, and there are some good questions coming in here. Are there rules of thumbs of where all the Greeks should be optimized? What a lovely question. Yes, let me bring up the 4-quadrant slide to go through that. There absolutely are. And it depends on the individual strategy. And I will say that's how options play is built, is it starts with an optimal strategy selection based on back testing, and then you can compare and contrast and make your decision there. But it starts with understanding the positive and negative factors, assessing that with your goal, but depending on the intent of the strategy. So short calls, for example, we always say you want to point to delta because you're reducing your directional exposure because you're selling delta at this point. You want something that will account for capital appreciation, but also enough theta decay, but not give you these risk factors. That's where those come in. There are rules of thumbs for almost every strategy. So when we go into advanced trading strategies, and I see a question there about earning condors and butterflies, I love doing presentations on those. We actually bring in the Greeks at that point, because then we talk about the positive and negative factors that are associated with it. But basically, you want to maximize your positive and negative factors. That's and there's harmony that's built in with it, because these are all centered around at the money options, whereas these are not. So therefore, one may say, I'll just use a long call for an example. Okay, if I have a long call, I've had this question quite often, actually, where someone will say, why don't I just buy the very deep in the money option? Well, if you buy the very deep in the money option, yes, you're already at your destination, you're giving up gamma and you're minimizing Vega, and you aren't giving yourself that acceleration to be profitable. You're already at that destination. If you're buying that deep in the money option, you might as well just buy the stock because it's acting like the stock. That's how we would utilize the Greeks and then put them all together. So I know that was a longer answer and not a very direct answer. However, an answer nonetheless. Another question, how do you decide the long debit call spread or short credit put spread when we expect the stock to be bullish? So we always focus on risk versus reward. I'll focus with strategy drivers. That's the way we teach here. So a bull call spread is an extension of a long call, and a bull put spread is an extension of a short put. These are the strategy drivers. It's an extension of the long call because we're giving up our directional exposure, but the deltas is going to be the driver. It's whatever that will be, tell us the driver. Nonetheless, whenever I am choosing these, it's actually from my goals here. Do I expect a sharp movement in the underlying security? If so, I'll start here. If it's too expensive, then I would layer on a short call to reduce the cost, the theta exposure, but still make sure I have some gamma exposure. And that goes to strike selection, which means that's why the long call is generally closer to in the money, maybe slightly in the money, but closer to the money. That way I still have some gamma exposure, because remember, these three are centered around at the money options. That's how that would be structured. So there's the distance there. I would select my distance maybe on a standard deviation, or honestly, options plays tool will just start that way, and you have access to that as a first trade client. If I'm not largely directional, we'll start with the short put. The short put requires a lot of capital because you have to have that exercisable value attached to it if it's cash secured. In order to reduce that capital expense, you may purchase a long put, and you'll see the positive and negative factors that are how it will be reduced or amplified. What's important to note here is this is sold for a premium. When I purchase a long put, yes, I'm reducing my risk exposure, but I'm also reducing the premium that I'm received, and I can only make as much as the premium. And I call that my upside risk. So that's the difference between, am I going to do a bull call spread, or am I going to do a short put, or bull put spread? What is my how far do I think this is going to go? Then you layer on technical analysis, price targets, all of the above if you so choose, but it's your process of where you think the underlying stock will go. That's one piece of it. So if you're not largely directional, Short put is absolutely fine, or the bull put spread. And then the other factor is, where is implied volatility? If implied volatility is high, this is going to be expensive. Maybe I can structure something to reduce that. But remember, this is centered around at the money options. So therefore, if it's high and I think it will go down, then I want something that will benefit from a decrease, which would be the short option. So those are the questions I would ask. Is we've decided our directional exposure. We're going to figure out if our time value components, is this in our favor or not? That's why we have starting points. Normally you'll see on the options play platform that the time until expiration for long options, so the bull call spreads, bear put spreads, always start around 60 days, is because that gives you enough time to sell to close that time that you've purchased. Short options are normally around 45 days because we want to capture that theta decay, but we don't want to hold it too long where we have this gamma risk all of a sudden increase, because that goes up as we get closer to expiration. So that helps with the expiration date here. And then strike price selection comes in with gamma and Vega, and then Vega will give us our net volatility exposure. And I think these are great to understand and to know and to wrap your head around. I'm the type of person that has to know something inside and out before I'll actually execute upon it. So I think it's important to discuss that purely for that reason. As adults, we all learn differently, and investing in your education helps build that confidence in order to make those decisions. But hopefully that answered your question, Theta. All right. Let's see if there's any more. Are there any custom metrics beyond Greeks that you would recommend we monitor? Justin, I want to stay away from the word recommend, but sure, there's absolutely lots. We look at implied volatility rank. That will tell us if an option is expensive or not. As an options trader, that's extremely important because, yeah, we can understand if we have a positive or negative Vega exposure, but where is implied volatility now? And some options just have high implied volatility because that's the way they are. They move a lot. Tesla is a great example only. That always has an implied volatility. And you could see that when you pull an options chain. So implied volatility rank helps you see, is it a higher or lower implied volatility in comparison to itself? So that usually goes from, or percentiles, another metric for that, 0 to 100. 50 is going to be your mean. So if the implied volatility metric is above 50, then that means it's higher than normal. If it's below, then it's lower than normal. And that will give you a good indication if it's expensive or not, which will help decide if I want to sell or buy. And that's net. And then, of course, if it is high, but you may say, okay, well, I since it's high, I think I should do a short put or a covered call or a credit spread, but I'm largely directional. Then that's where this really comes into play. And you can get into that advanced stuff where you'd say, okay, I'm directional. Let's start with a long call, but Vega, I benefit from an increase in implied volatility, but it's already high. So let me reduce that, which would be by selling a short call. But since this is centered around at the money option, and it's probably going to be where you're selecting that, you may sell 2 of these and then create a long call butterfly, which would just have another long call that's further out of the money to reduce that type of exposure. So you can get creative, and that's the way that I wrap my mind around those advanced 3 and 4-legged option strategies. Is literally the intent of them is you structure your trade to make these positive and negative factors be to your benefit as much as possible. So delta is direction. Everything else is, does this hurt or help your option strategy? So we want to reduce the negative factors, amplify the positive. Apologize for the long-winded answers today. Dora asks, where can I find Greeks data in First Trade? I know they just added it to their mobile app on their options chain. I believe on their website as well. So just pull up the options chain and you can see the Greeks. We also have it within the options play tool, which is found under options play wizard. If you select a strategy, below that, we put it in what's called plain English, where we actually net everything together for you. All right. We went 2 minutes over, but I sincerely appreciate all of the wonderful questions. And I hope you found some great information out of this. We are very feedback oriented, love working with First Trade. So if you have any questions that we didn't cover, please feel free to reach out to them or let them know what other sessions you'd like us to know. We are here for that. Our job and our mission is to make sure that we just amplify options education and ensure that you know the ins and outs of options trading so you can make those confident decisions. So I definitely commend you for making the investment in your education today. I hope you have a wonderful day and a great week, and we'll talk to you soon.